As we start the first week of September, there are some critical things that you need to know. September is the worst month by far over the past 10 years. And in fact, in 2020, September was down 4.1%. In 2021, September was down 5%. In 2022, September was down 9.6%. And in 2023, September was down about 5.3%. So over the past 4 years, September has been a terrible month for stocks. And I think this September, that could be amplified a lot. It could be a great September, or it could be an even worse September than potentially some of the prior Septembers we've seen. And I think a lot of this is going to come down to, unfortunately, this week. Now let's start with the earnings lineup, because although the economic data is going to really be the big story of this week, there are some earnings that are interesting. Tuesday and after hours, you have Zscaler, GitHub, Asana. Wednesday pre-market, you have Dick's Sporting Goods, Dollar Tree, Hormel, and some others. Wednesday and after hours, you have C3 AI, Hewlett Packard Enterprise, ChargePoint, Casey's, and some lesser known companies. Thursday pre-market, you have Neo and Toro. Thursday and after hours, you have Broadcom, big AI stock there. UiPath, Samsara, DocuSign, Planet, Braze, Zoomy, Smartsheet. And Friday pre-market, you have Big Lots. So not super important earnings, but some of those companies, like a Broadcom, can move broader markets. But as far as this upcoming week, it's all about the economic data. Now on Monday, you don't have anything at all. Literally not a bond auction, not a Fed speaker, nothing. If there was a day to just relax and take off, it's probably Monday. Now, starting on Monday will be September 2nd, and there are some seasonal negatives that tend to happen in September. For one reason or another, September is the worst month over the past 10 years by far for markets, with a 30% win rate, negativity average over the last 10 years of negative 2.6%. The only other month that is negative on average is December. That's negative 0.2%. Like, September's a pretty rough month for stocks, okay? The last 4 years, in 2020, you were negative 4.1%. In 2021, you were negative 5%. In 2022, you were negative 9.6%. In 2023, you were negative 5.1%. So to just brush this off and say this doesn't mean anything would be false, okay? For one reason or another, stocks do not historically perform well in September. But this time, again, is a little bit different because September 18th is going to be the first Fed cut. Normally, stocks can perform well on the Fed reducing rates, but it comes down to the economy. It comes down to why is the Fed cutting rates? If the markets sniff out the Fed's cutting rates because they're concerned that the economy is weakening and getting worse, that becomes very problematic. So really, long story short, as long as the economic data comes in strong in September, it doesn't have to be a weak month. And I would expect it would be a pretty strong month in that event. Now, on the headline S&P, I'm not expecting much upside. Now, you're definitely coiling. You could break out from here. You're coiling just back and forth, sitting right at resistance around 560. You're breaking above that. You're falling back below that. The markets are trying to figure out what's, where to go next. And if the economic data comes in good, you definitely could move higher from here. But markets, generally speaking, as a whole, are kind of priced for perfection. So I wouldn't be surprised to see a little bit of downside, mainly coming from big tech, some of the areas that are overextended, and a broadening out of our markets that could ensue as long as the economic data again comes in good. Now, Monday, again, we have nothing. Tuesday, you have ISM manufacturing PMIs. This data is for August. You're expecting 47.8. Last month was 46.8. So you're expecting a 1-point improvement. But manufacturing PMIs, they're still negative. So if we could see this come back a little bit, that would be good. Although there's kind of worrying signs in the manufacturing sector still that we're probably still in a manufacturing recession. So not expecting much great news there, but any marginal improvement is going to be seen as positive. You will get construction spending month over month, expecting that at positive 0.1%. Last month, it was negative 0.3%. ISM manufacturing new orders expecting to come in a little bit better as well. And ISM manufacturing prices expecting to come down a little bit. And that would be seen as good news on the inflation front. But besides that, that's pretty much it. You do have some bond auctions, 3-month, 1-year, and 6-month bond auctions. Really not going to be important. You will get total vehicle sales as well for the month of August, expecting 15.4 million, down from last month of 15.8 million. Now on Wednesday, you have the JOLTS job openings. Now this is what's interesting about job openings, okay? Job openings, think about it like this. If you're a company and you're doing well, you're going to look to hire more people. If you're a company and you're not doing well, you're going to be laying people off, firing people, or not looking to hire as many people. So JOLTS job openings, if it comes in high, is going to be seen as good news for the economy, good news for the labor market, because businesses presumably must be doing just fine. If we come in low and do see a big drop, that's going to spook markets. That's going to spook markets a lot. So that's definitely the first big data point, economically speaking, besides ISM manufacturing. But I think this is more important than that. That could kind of spark some fears about the broader economy. So definitely keep that one in mind. We will get factory orders month over month as well, expecting that will come in at 4.5% positive. Last month, you were negative 3.3%, so pretty high expectations there as well. You will get the Fed Beige Book at 2 p.m. as well on Wednesday. Thursday, ISM services PMIs, expecting those at 51.5. Last month was 51.4. So services is very important because you have manufacturing that's been in a recession for 2 years plus now. Services have really been holding things together. Now, services have been declining, okay? There's definitely a downwards decline that has started to take place. Now, services briefly in June and April did go slightly under 50, so slightly into contraction territory. If you go back into contraction territory, markets are not going to like that. Because if services start to roll over, manufacturing's rolled over, it's going to be hard to stop any further weakening. Now, ISM services business activity expected to come in at 54, down from last month's 54.5. Services employment expected to come in at 51, down from last month's 51.1, so a little bit of weakening there as well. ISM services new orders expected to come down from 52.4 to 52.2, but just slightly, not big drops. ISM services prices are expected to come down as well from 57 down to 56.7. And again, this data is for August, so it's not as lagged behind. We'll see, though. I think all of the economic data to a certain extent is just very lagged behind. 3 to 6 months in some of these data points. But ISM tends to be more, current because it's more of a survey than actual, hard data points. So that's definitely something markets are going to pay attention to. Friday is your big catalyst, okay? You have non-farm payrolls. Last month, after the revision, we came in at 114,000. Yikes, okay. Things are kind of weird for the estimates. The consensus is 163,000. The forecast here, as you can see, is 100,000. So you're expecting some pretty rough numbers, okay? Not great numbers, in other words. If we come in high, markets are going to love that. If we come in at like 180,000, even 200,000, markets are going to absolutely love that. If we come in less than 100,000, markets are going to say, oh crap. With any revisions that we get, that could actually be a negative month for payrolls. So I think that is really the big story of this week. And I think, this jobs report is going to take place on September 6th. With the weak seasonals for September, if you do see non-farms miss and come in low, that could spark that seasonal weakness in September. This could be the catalyst that could cause that seasonal weakness in September. If we are going to get seasonal weakness in September, it's probably going to come from this. Now, the unemployment rate is actually expected to fall from 4.3% to 4.2%. If we come in at 4.3%, not necessarily a big deal. Yes, you would kind of miss the estimates. That wouldn't be great from that perspective, but it wouldn't be getting worse. Wall Street just doesn't want to see this get worse. Let's say we do come in at 4.4% and we actually tick upwards. Yeah, I would expect September is going to be a pretty rough month from that standpoint. Now, is that going to happen? I don't know, but it's definitely a big risk. And from that perspective, it wouldn't surprise me if markets actually trade lower heading into next Friday because of how big this catalyst will be. This catalyst on Friday, the jobs report, the unemployment rate, is really going to solidify investor sentiment around the Fed's first rate cut. Now, historically, if the Fed is cutting rates into a weakening economy, into a recessionary economy, the markets do not like that, okay? And normally in that situation, stocks are actually down over 20%, around 23%, the next 90 days following the first Fed rate cut. So that could mean the end of this year would be rough. I mean, you would give back all of the gains for 2024 if that were to play out. And this is the only non-farm payroll report we're going to get in September. The Fed's going to be cutting rates as the markets price in September 18th. If this catalyst this Friday on September 6th is bad, if we get a jobs report that is, say, sub 100,000 jobs, let's say the unemployment rate ticks up to 4.4%. God forbid it goes to like 4.5%. You're going to have a very rough September again, and it could be worse than the last couple of years. If we do get a jobs report that comes in on the strong side, that comes in around estimates or better than estimates, and the unemployment rate actually falls a 0.1% as the markets are pricing in, then you could actually set up for a very strong September. You could actually see a broadening out of this market. Now, keep in mind, big tech controls like 40% of the weighting in the S&P and the NASDAQ. I believe it's closer to 35% of the S&P and 43% in the NASDAQ, to be a little bit more specific. Now, those companies, they don't benefit from the Fed lowering rates. They actually lose out, because there's less of a safety trade that needs to be put on. There's less recession risk if the Fed cuts rates at the right time. Less interest those big tech companies are going to take in to their bottom lines based on the interest that they are collecting off their excess cash. So for many reasons, the literal reasons why big tech did so well over the past 18 months, almost 2 years now, will start to go away if the Fed can actually engineer a soft landing. So it wouldn't surprise me if big tech actually sold off on Friday or did not perform as well as the rest of the markets. And I would expect a broadening out of this market with small caps and cyclicals and value and high-paying dividend stocks to really outperform in September relative to big tech. Now, that could mean the S&P goes up a bit, 3 to 5%, wouldn't surprise me. Big tech would probably at least do okay. But it also wouldn't surprise me if the Russell and the equal weight S&P did 10% in September. If this Friday's jobs report comes in good. Now, again, if I were to put my opinion on this, I think the economy and the labor market are probably worse than the data that we are seeing. I think the data is very lagged behind. So I think the data that we are getting now, this report for September, is really like the economy back in June, okay? The labor market back in June. So I'm not super concerned about this Friday's report. I think there's probably a 60% chance or so it comes in okay or good. there's maybe a 40% chance that it comes in bad. And we could also get a bit of a mixed bag as well. Maybe the unemployment rate rises. Maybe the jobs number itself comes in good. We'll obviously see. That can give us some mixed reactions, and we'll make this month of September a little bit more difficult to game out if we get a bit of a mixed report. But I do think the odds are in our favor of a broadening out of our markets, of a decent jobs report at the very least. And let me tell you, this is the biggest catalyst of this month. CPI doesn't matter coming out around September 11th. The Fed, to some extent, doesn't matter on September 18th. It matters what the economy is doing. Now, again, if the economy is doing well and the Fed cuts rates, that's great. That is like the cherry on top of the sundae. If the economy is doing bad and the Fed is cutting rates, then that's not going to be seen as a positive for markets. Let me know your thoughts on this down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. And let me know your thoughts around our markets this week and what the month of September is going to bring for us. You guys have a great rest of your day. Enjoy your weekends, and I will see you in the next one.